Hey everyone, my name is James Tarkenton. I'm the Chief Investment Officer here at Townsend Asset Management. We recently had our 2021 mid-market update live, and coming back now to give a short recorded version of what we discussed for those that couldn't attend. And as we've tried to do from time to time, or with these webinars, is we try to keep them at least remotely interesting, and try to alter formats a little bit to keep the focus. And this time, as opposed to going through slides and following up with questions after, really just felt like this was a meeting for our clients, and we wanted to give them an opportunity to ask questions up front. And while we don't have that opportunity to do that on this format or this session, I can certainly review some of the questions that were discussed, some of the key points. And one of the main questions was, our thoughts on inflation, and assuming a higher level or an expectation of increasing inflation. What were some of our highest conviction ideas or positions that we had in the portfolio that would be able to offset some of those pressures that typically occur in equity markets due to inflation. And just a couple of thoughts there. That definitely has been the talk this year, is inflation. And each month you've seen some of the absolute year-over-year numbers being reported, and multiple tens of years have seen readings that haven't been seen in 13, 14 years. And the Fed chairman saying that these are transitory issues. And that very well may be the case, may not be the case. We need to get to the point where we're looking at year-over-year numbers that are more relevant. A year ago, the entire country was shut down. There was no purchasing of anything short of toilet paper and shampoo. So certainly, we have, since the vaccine and since coming out of October, November of last year, we've certainly seen a rise in purchasing and travel and people getting out. So certainly prices have increased. We're seeing the pressure on labor, getting people back to work, incentives being offered to make that happen. And so on a year-over-year basis, there certainly has been a rise in inflation. And as we get to the back half of this year, we'll have to see where that is to see if the Fed chairman's correct and if any other measures need to be taken. But as far as conviction ideas, we don't spend a lot of time at Townsend trying to forecast or alter portfolios in a near-term framework to try to monetize our expectation of what inflation and when it would occur. We spend all of our time trying to find companies that have the characteristics that should be able to thrive really in any environment. Certainly an inflationary environment is a harder environment for companies to maintain their profitability with pressures on costs, et cetera. But really, one of the ways we try to do that is finding businesses with recurring revenue, or businesses with value propositions that are needed regardless of what's going on outside. And one of those is a company that we've owned and bought and owned for a while, and that's Accenture, a consulting and outsourcing business. This is a company that has about 75% of its revenue recurring. There's not too many senior management teams that wake up one day and are trying to compete and be relevant in an increasingly competitive world, and looking for advice on where and how best to do that, and then deciding because it's inflation, it's an inflationary environment, they decide they don't want to be as good as they could possibly be. So something like an Accenture should hold up well in an environment like that. Pricing power is another attribute that we look for. I make a kid about this from time to time, but if you've got an 8-year-old little daughter, and you tell her you can't go to Disney World this year because ticket prices are 8% higher, that's not going to be a pleasant evening at the house. And I can't think of someone who would would not make a plan for a vacation to Disney World or, some type of relationship with Disney because, they've raised prices 5%. It also counts towards, their streaming business. I don't see people cutting off content and, having access to certain content because maybe that content costs $1 a month more. So, looking for companies like that. While we're obviously trying to evaluate and determine the pace of the recovery, especially given current events, meaning Delta variant and everything else. If you're running a hotel like Marriott, you can reprice those hotel rooms every night. And that's a huge opportunity to operate within an inflationary environment and maintain profitability. A couple other companies from back at the recurring revenue side is a company we've been picking up lately, American Tower. This is a company that builds the towers, that holds the radios that are used in wireless communication and data transmission. You're talking about 3-year contracts with 3% annual escalators in price. The large, Verizon, AT&T, T-Mobile, they hang their radios on these towers that are owned by American Tower, and they're paying a monthly fee to American Tower. And the interesting so we've got pricing power there. That's one aspect to it. But one characteristic about 5G is that the data, while quicker, it can only travel a shorter distance. And so you're going to need more towers and more radios. So not only do we have pricing power in an inflationary environment, we've got unit growth. So that's something that we've, and it's, it is structured as a REIT. Real estate is another well-known and thought about inflationary hedge. So, there's still opportunities to find companies that can operate in an inflationary environment. Not only do we not spend time trying to guess really what inflation is going to be, it's important to stress that it's never really where interest rates are on an absolute basis. So I think interest rates finished yesterday at 1.17. We started the year at 0.79. We got to 1.7, and now we've pulled back to sub 1.2. But it's never what the number is that's important. It's always the trajectory, where it's going, and the pace at which it's getting there. Slow, gradual growth in interest rates is actually positive for the equity markets because it means that you're getting solid macroeconomic growth, which is supportive to growing economy and supportive to higher earnings, and equity prices respond accordingly. So just keep that in mind that we want to know what the pace, and we want to know the direction. I think we're pretty comfortable with predicting the direction that we're going in, given where we are. It's just when do we start going there, and what is that rate for which we're going? One other question was specific to the infrastructure bill that is being pushed through Congress, and there are we have two names that should benefit from that. One of them is a company that we've held for a couple of years now. Is Wabtec. This is the rail and transit business. About $100 billion of the $1 trillion is allocated towards freight and transit. So Wabtec should benefit from that. Also, a company that's relatively new to the portfolio in the last 12 months is Mastech. They operate in 4 verticals related to infrastructure. That's communication. So obviously, kind of when you're looking at a business in a certain vertical, you come across many businesses, and so Mastech and American Tower, kind of work together, so to speak, in the communication space and building out the 5G network and wireless transmission and data transmission. They're also in clean energy, so renewables. They have a little bit of oil and gas, and then electrical transmission. So both of those companies within the portfolio should see some upside from the infrastructure bill. There were a couple other questions. There was a question about debt and debt levels. Again, when you own the printing press, the level of debt doesn't get put on the forefront as far as pressures on the economy. But that being said, we're still trying to see if when and how it does become relevant. But I do have some slides and some points I wanted to get through, and I'm going to go ahead and jump to that now. Share my screen so that we can work through these and kind of just an update on where we are and some thoughts on where we're going, and some comments on staying true to strategies that we think are relevant over the longer term. So here we are. This is the S&P 500 through yesterday. We're up about 17% on a price basis, close to 18% on a total return. I'll remind you that last year for the year we were up 18%. But as we talked about in February, it was a very tightly driven market performance, with the top 5 companies by size contributing a significant majority of that upside. So the market was up 18, and the top 5 were up over 50 each. And the other 495 companies, S&P 500 companies, top 5 were up over 50. Bottom 495 were up on average about 3% to get to that 18. So while I was trying to look for some data that would give me something similar to tell you year to date, couldn't find it on an individual contribution basis. But as far as something I think is pretty interesting now, just given the tech rotation, and which we'll talk about a little bit more, I think it's interesting that Berkshire Hathaway now has a larger contribution to the S&P 500 performance than Tesla does. You may not be aware that Tesla's trailed. Not only is it trailed, but it's actually negative year to date versus 18 for the S&P 500. So Berkshire's kind of jumped ahead of it in the stack of contribution to the performance. So long-term average for the S&P 500 is 8%. Certainly had a number of years where we've been above that. But with 490, at least for last year, 495 companies up, averaging about 3%, we still feel that there's areas that we can take advantage of the environment and, find really good companies at good prices, and arguably, a full price market, which we will demonstrate here. So where's the performance coming from? These are the 11 sectors of the S&P 500. Dark blue bar would be the S&P 500 as a whole. And you see that, energy, real estate, excuse me, financials, communications kind of leading the market. As we entered the year, as we just spent time talking about, people were worried about inflation, and people were looking for a recovery. So on the recovery side, you see, financials and energy being a large contributor. Energy, obviously, with planes flying, cars driving, boats floating. There was a demand for oil far and above what has been in the recent past, and that sector has responded with that demand. Now, that being said, it has to be in consideration that energy was down 50% last year. So want to keep that in mind. Also, financials. Everybody has acronyms for their business, but big in financials, and at least the large money centers, net interest margin, or NIM, is the largest contributor to a bank's financials or bank earnings. And it's essentially the spread between what they pay for deposits and what they earn on loans. And in a rising interest rate environment, That's obviously directly positive to the bottom line of financials. We own JP Morgan. We own a little bit of Bank of America. We own a little bit of Goldman Sachs. That's a little bit different as far as pure NIM standpoint. But we've got some exposure to financials, and they've done well this year. But that's part of that rebound. And as I talked about before in the discussion on inflation, real estate really has been looked to as a hedge on inflation. So I think that anticipation has driven that space. I think it's interesting to look not only at what's contributed the most, but what's contributed the least. And I would argue, the strategy, given that the Fed has basically said you're not making any money unless you are in the equity markets, i.e., don't look at the fixed income markets. A large strategy over the last number of years has been equity substitutes. So if I can't get any income on the fixed income market and I have to go to the equity markets, where do I go get it? It's in those sectors that arguably have characteristically the least amount of growth, but also the least amount of risk, and pay healthy dividends, healthy income. And that's consumer staples and utilities. I think with the expectation as the vaccine started to roll out, we started coming out of COVID, just as in general, you see those two contributing the least. Also, going from 0.79 to 1.7 in the first 3 months of the calendar year, I think you start to see a rotation back to that fixed income side or more true fixed income investments. So we know what the value is. What are we paying for it? So this is the S&P 500 forward PE ratio, PE being the price divided by earnings. This is arguably the most well-known, simplified way to discuss the price of the market at any one time. You either look at it as a whole, or if you're looking within an industry, others within the industry, which one is priced the most. Obviously, a higher PE means it's more expensive. Lower PE means it's cheaper. And you see that, we're pretty full here at this level. I don't think we're anywhere close to the characteristics or the foundation of what the tech bubble was. But this also argues that, for active management, the 495 companies that were up on average 3%, we aren't blindly going to buy the market as a whole here. We're trying to selectively pick, those opportunities that not only have the characteristics that we look for that typically are priced more appropriately, but haven't participated in the overall upside, which for the most part has been, very large tech, large cap tech, large capitalization, meaning the size of the company, large cap tech, which there's no question. And we did a pretty thorough example back in the February capital markets presentation on the effect of interest rates on valuations. And as those interest rates drop, those far off future cash flows for some of these tech companies actually become much more valuable in that environment than in a higher interest rate environment. And we certainly think that has driven some of the outsized performance in that space. This is actually one of the most, at least for me, one of the most important slides that you'd want to pay attention to. So this is the S&P 500 index relative to trailing earnings. The Tar Heel blue shaded area is the earnings. The dark blue or dark black line is the S&P 500. And bottom line is you get concerned when these become out of whack, whether it's, you become concerned if the earnings drop below the index to any great extent, and you become more optimistic the higher and the longer that shaded blue area is above the line. And you can see that, we're about at parity. So, you want to argue that the market is, expensive. Well, this would argue that since stock prices follow earnings, we're probably where we should be. The question is where earnings are going to go from here. Obviously, everybody, at least today, we're wrapping up second quarter earnings reports for the S&P 500 for most companies. And the question is, does this COVID growth continue and to what rate? I will tell you that, to date, 84% of companies reporting in the S&P 500 have beaten their estimates, and that compares to 74% over the last 4 quarters. I also, just an anecdotal, there's the investment industry, there are a group of people that are paid extreme amounts of money to estimate what these companies are going to earn. And this is just one example of having an independent mind and have your own opinion and do the work yourself and not be affected by the idea of some JP Morgan, Goldman Sachs, Morgan Stanley, Credit Suisse, these analysts that you'll see on the financial media. They're paid large amounts of money to get these estimates right or even remotely right. And Apple's fiscal year ends in September, but as their year started, the fiscal year we're in, the estimate was that Apple's earnings would grow 11%. Well, after this last quarter, estimates now are that year over year earnings growth will be 51%. So people that get paid a whole lot of money to get this stuff right have missed by 5 times. So again, do your own work and now do it well, but and thoroughly. But just because someone works on Wall Street doesn't mean that they're right. Just a couple of slides that we like to show. Here's the S&P 500 total return for the time period in the blue bars. The red dot would be the largest drawdown point for the year. So if we look at 2020, we were up 18 for the year. Obviously in March at the weakest point of the market, strongest point of COVID and the realization that we were going to be shutting down, it was down 34%. But if you just look across the chart and the time periods, for the amount of time that we spend or getting concerned about markets dropping, Monday 2 weeks ago, the market was down 2% in one day. You would have thought that things are going terribly wrong, but hopefully this chart shows that at various points, that's the norm. And you have to be comfortable that you own the right things so that when times like this happen, you're more comfortable than you are scared. And you stick with the portfolio and your companies as long as they're doing what they're supposed to do and achieving what they're supposed to do. But, back to my point of 8% long-term returns, if we go back to 2016, we've got a 12% return, a 22, a -4, 31, 18, and 18. And that's the last 18 is year to date. So just if we revert to the mean, I think you should expect overall equity market returns, not necessarily be negative, but they're not always going to be double digit. And to that, it's similar to that point, I should say. Another one we like to show, these are the number of 5% pullbacks in any given year for the S&P 500. And hopefully you can see the red dotted line that the average is 4.5 times a year. There's a 5% pullback. 4.5 times a 5% pullback. You see in 2020, there were 12 of those. In 2017, there was 0. Well, year to date, we've also had 0. So we're long overdue for some volatility. This is why you build portfolios of high conviction names. And when those points of volatility present themselves, you take advantage to upgrade your portfolio whenever that opportunity presents itself. Just a quick review of interest rates. As we started this year, again, we were sub 1. There was, anybody you put on TV would say that we were going to finish the year at 2 and going higher. And it almost, the prophecy almost fulfilled itself. We got up to 1.7. You can see here, but within a matter of 3 months, the market perception or the market momentum shifted, This was also, as we'll talk about at the end of the presentation, the rotation out of growth to value, that cyclical companies were going to rebound with the rebounding economy. You needed to alter your allocations away from growth to value, participate in that rally. And as you can see, 3 months into the year, at least on an interest rate, but also on the growth value argument, that's somewhat reversed. Over the last few weeks, large tech has taken over, values pulled back, but we're not going to make 3-month calls on portfolios. We're trying to look over the longer term, and I think you should too. Just simply where the Treasury yield is today. The blue line is where it is today. The yellow line is June of this year, and the red line is December 31st of last year. So rates have moved upwards in general. It is a steepening curve, which is more the norm. One of the favorite ways this is used in determining a slowdown or a recession would be an inverted curve, where you're actually getting paid more for shorter periods than you are for longer periods. But this is obviously this would be considered a more normalized yield curve, where for longer maturities you're taking more risk, you're getting paid more. Now, that being said, on an absolute basis, these rates are extremely low. Just another point on corporate bond yields by investment grade. So investment grade or corporate bonds are rated by their credit worthiness. AAA being the most secure, CCC being the most scary. Typically, you'll hear people talk about junk bonds. CCC bonds is what they're talking about. I do find it an interesting note to reiterate that if you're an ultra conservative investor and you only want AAA bonds in your portfolio, and while you may sacrifice some income, you are sleeping well at night because of the credit worthiness of your AAA bond portfolio. There are only 2 AAA companies in the market in the U.S., and that's Microsoft and J&J. But credit, investment grade bonds are bonds anywhere down to BBB. Anything below BBB is non-investment grade. And the further you go down the rating curve, the more risk you're taking from a credit standpoint. Now, that CCC 7.2%, that's just north of what kind of an average Fed funds rate has been. So we're certainly, you're not getting paid for the risk you're taking up the credit scale here, in our opinion, by no means. And so, if you look through past and where these interest rates are based on credit worthiness, you can see that these things are pretty tight right here, and you need to be pretty careful. Next few slides is essentially an argument on why we're more optimistic than pessimistic as we look out over the near term here. This is the leading economic indicators. So this is surveys filled out by participants in the market on various different indicators and where they see them. The shaded bars are recessions and the historical recessions. I will point out 2020 is the last recession related, obviously related to COVID back in the first of the year. So February, March, and April of 2020, there was a recession, also the shortest recession in the history of the U.S. market. The other point is you see that each time we've gone into a recession, the leading indicators have turned negative. They're varying lengths of time from when the leading indicators turn negative and when we were actually in a recession. But obviously we're in a pretty strong position currently from a leading indicator standpoint. So that obviously bodes well. Here are job openings. I'm sure everybody's been paying attention or hearing about job openings and trying to get people to come back to work. I mentioned it at the start of the discussion. 9.2 million job openings. There are actually more job openings than there are able people to fill them. It's not the economy is not working 100%. Only if we get 9.2 million jobs filled. It is a belief here, at least here at Townsend, that that's quite a margin of safety as far as, getting, having the opportunity for people to get back to work, start generating earnings and start spending and buying and driving the economy going forward. So obviously, certainly appears to be quite a bit of room for, upside in the economy if we can get people back to work. Household net worth. This is, clearly, it's never been in a better position. A lot of that, frankly, as you see the bullet points at the bottom of the graph, that is a byproduct of, stock market returns, low interest rates, rising home prices, and steady economic growth. So this obviously could change, based on interest rates or other factors. But bottom line, meaning that the U.S. consumer and household is in extremely good condition. And to even reiterate that more, here's household debt service. So debt service, this would be the percentage of income being used to service consumer and mortgage debt. We've typically been just above 11%. And we're clearly far below that. Whether on a consumer debt service or household debt service, the American consumer is in good shape. We get him back to work. He or she is not covered in debt, and they're highly liquid. So we would expect that to be supportive to things going forward. And this is a slide we showed back in February. So I want to make sure we pay attention to that. So here we have January 21, March 21. So somewhere in here is when we made the last presentation. These are the number of daily travelers moving through the TSA checkpoints. And we are above. We are at pre-pandemic levels. People are getting on planes. People are going places, visiting families, staying in hotels. And I would remind you that this is through yesterday. So even on the concerns of the Delta variant and the levels of vaccinations, et cetera, it certainly does appear that at least in the United States here, people are ready to get out and do things. Part of the reason why we like some of the hospitality names that we do own. So then lastly, just to wrap up, just the talk of inflation, this 5.4 reading on CPI, it's the largest increase since 2008. So a lot of talk about just the absolute numbers, but again, we've got to get to the point where we've got more true and measurable year-over-year comparisons of coming out of the pandemic. And so the back half of this year is where we're more focused. I think more time, at least currently, should be spent looking at the month-over-month change in inflation. So June to July, or May to June, or July to August is probably more relevant. Now, it's still going to be on a higher end, but as we get to the tail end here, I think the talk of extreme runaway inflation should die down a bit, but certainly something that we want to pay attention to, and where we want to make sure we have a portfolio with companies with the right characteristics to combat this, because again, we're not going to get it 100% right on when and how much. So let's pick companies that should be able to operate really well in that environment, or if the environment doesn't show up. So that's how we spend our time. And then lastly, the talk of the investment world at the turn of the year was that shift from growth to value. Now it's kind of hard to see on here, but the line you want to look at is the red line. This is the difference between growth and value. So if growth is doing better than value, it is increasing. If value is doing better than growth, it is decreasing. And just this little bit right here, you can see that at the turn of the year that started to happen. But I think it'll be more even or maybe more flatlined than it was earlier this year, because the investment dollars have changed again. And so, we're not going to make calls on a 3-month basis. We want to set a good, solid allocation in portfolios and, participate as the market goes, as opposed to overweighting any one particular way, thinking that we know where the market's going to go more than anybody else, because there's no one that knows that. So that was really the presentation for the mid-market update for 2021. If obviously you have any questions, don't hesitate to give us a ring. We appreciate you checking in and looking at the presentation. And just as a reminder, our next webinar is in September. Please look at the website, check that out. But short of hearing from you, appreciate your time, and we'll talk again soon. Thanks.